It's becoming clearer and clearer by the day that the economy is starting to slow down as consumers are becoming more and more troubled financially, but the question on everybody's mind is how big of a slowdown are we going to see? Well, last week we got some answers, as a number of major warnings from giant corporations, combined with new economic data that is emerging, all suggest that things are heading sharply in the wrong direction, and it looks like a whole load more pain will soon be coming the way of many consumers. So April payroll figures came in on Friday, missing by the biggest margin since 2021, as the economy added just 175,000 jobs, far below the estimated 240,000 figure. This is also 50% lower than the revised 315,000 number of jobs added in the prior month of March. This only backs up that job growth looks to be on a downwards trajectory since 2021, looking at this chart, and these new numbers that are coming in only further prove that growth in the US labour market is slowing down as employers hit the pause button on new hires. Meanwhile, unemployment has risen to 3.9%, which was above both the estimated figure and last month's figure of 3.8%. This means that unemployment is continuing to tick upwards, following the upwards trend that has been taking place since last year in April 2023, when the unemployment rate was 3.4%. Already in 2024, we have seen hundreds of large companies make layoffs, particularly in the tech sector. And in fact, April has been the worst month of the year so far for tech layoffs, with 22,000 employees being laid off last month, including layoffs from some massive global giants like Google, Apple, Tesla and TikTok, just to name a few. We are also seeing the total number of job openings continue to decline aggressively, and although we are still above pre-pandemic levels, this current decline is happening at the sort of pace that we have only really seen during previous large recession periods throughout history, like the dot-com bubble and the Great Financial Crisis. Last week, we also saw two giants in the consumer discretionary sector report their earnings, and both were quite underwhelming and came in with notable warnings about consumer weakness and a deteriorating economic environment. Starbucks had a really weak quarter, missing revenue and earnings estimates, with their CEO saying, "Still we face a challenging operating environment. Headwinds discussed last quarter have continued. We continue to feel the impact of a more cautious consumer, and a deteriorating economic outlook has weighed on customer traffic." The emphasis on this last part does suggest that consumers are not in as good of a place today as they once were, and consumers are in general poorer and have less money to spend on discretionary items. McDonald's, another consumer discretionary giant, backed up this message too in their new earnings report, missing earnings estimates as well. And the CEO said on the earnings call that consumers continue to be even more discriminating with every dollar that they spend, as they face elevated prices in their day-to-day spending, which is putting pressure on the industry. Apple is also a great company to look at to get a steer on how the consumer is currently doing, and they are seeing declining revenue year on year. And although this was consistent with guidelines and estimates, it doesn't exactly scream positivity for consumer strength when the largest company in the world, who makes the majority of their money from selling products to consumers, is seeing declining consumer demand. Also, just the other day, Tyson Foods, the second largest producer of meat globally, saw their stock price plunge after warning about heightened inflation having a big impact on its poorer working class customers, causing them to reduce their purchases. A direct quote from leadership on the earnings call was that the consumer is under pressure, especially the lower income households, and in retail we're seeing roughly 20% cumulative inflation over the last 3 years. Now the inflation impact, coupled with historically low savings rates, has created a more cautious, price-sensitive consumer who prioritizes essential staples over discretionary categories. All of these warnings from these giant global consumer companies are painting the same message. Many consumers are being squeezed for every last penny that they have just to cover the bare essentials, and there is very little money left over for anything else. With all of this strain on consumers increasing, we have seen the Conference Board Consumer Confidence Index fall for the third straight month in April to 97, down from the 103.1 March number. This is the lowest that the index has fallen to in 2 years, with Chief Economist at the Conference Board, Dana Peterson, saying consumers became less positive about the current labour market situation and more concerned about the future business conditions, job availability and income. He added that elevated price levels, especially for food and gas, dominated consumers' concerns. Meanwhile, expectations for the next 6 months have fallen to the lowest level since July 2022, largely for the same reasons, with consumers being less optimistic about their family's financial situation. And according to the Conference Board's survey, an alarming 81.5% of consumers plan to reduce their spending in order to save money, with the largest cost-cutting categories being eating out, clothing, entertainment away from home, and vacations. And perhaps the most concerning thing of all of that is that 20.3% of people plan to cut down on their grocery spending. On top of all of this, we're seeing consumer credit card debt surge month after month to new all-time highs, while the interest rate people are being forced to pay on this debt is also at record highs. Meanwhile, the personal savings rate is also continuing to slip further, now at new 2-year lows, and remains far lower than standard savings rates that we have seen pre-pandemic. So with the labour market weakening, costs rising, personal savings being eroded, and many families being forced to take on more credit card debt just to sustain their living costs for necessities such as groceries, it certainly looks like things are deteriorating quickly for consumers in this economy. Consumers being extremely weak today and likely to continue to get weaker in the future is going to have a big impact on corporate profits, which could hit the stock market quite hard. As consumers continue to get squeezed for more and more just to survive their day-to-day lives, there's going to be less and less money available to be spent in other areas of the economy. Less demand for goods and services is going to have a negative impact on a number of companies' profits, as we've seen already with the companies that reported earnings last week, as mentioned earlier. Looking at the stock market today, the S&P 500 is sitting at close to all-time highs, and valuations are also looking quite lofty, with the forward PE ratio for the S&P 500 currently being at just under 20, which is much higher than the historical average of around 16 to 17. If we keep seeing companies miss earnings estimates and start to adjust their forward-looking guidance lower to accommodate for this weakening consumer spending power, then the stock market is going to have to fall just to maintain this current valuation, which is a valuation that some would consider already to be quite high. And of course, other asset classes and markets, such as real estate, are also going to be negatively impacted from weak consumers as well. Weaker consumer spending power leads to less demand for homes from new home buyers, as well as increased housing foreclosures from existing homeowners who can no longer keep up with their mortgage payments, a trend that we have already started to see take place. And in fact, looking at trading activity in markets such as gold, it seems that many investors, including large institutions as well as global central banks, are even beginning to prepare for the end game, where we could see major currency devaluations take place. My previous video goes into more detail on this topic, which you can check out by clicking on screen right now. Aside from that, if you enjoyed the video, please leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.